For those who don't know, my name is Sam. I set up Gravitate Accounting 6 years ago now with the aim of working closer with our clients and trying to find ways to add more value. Last year we set up a corporate finance department, and the aim of that was to we were working with bigger and scaling businesses essentially, and the plan was, okay, we want to be able to support them on that full journey from start up to scale up to the exit they wanted, and as part of that it created a lot of tax work. So this year it took us a couple of years to find the right person, but this year we took on Luke, who is Gravitate Accountant's tax partner, and yeah, so he's just joined us a month ago now, and probably worth you just spend a couple of minutes talking about you, Luke, and what your history is and stuff.
Yep, so prior to joining Gravitate, I've worked in the accountancy and finance sector for about 15 years. Originally trained up as an accountant and then a chartered accountant, and through that sort of 6-year path realised that tax was the thing for me. So sort of partway through that journey I was training up for tax specialism, and then over the last sort of 10 years specifically that's been sort of pure tax. I've headed up departments in other firms in South Yorkshire, and exposure-wise, I advise sort of businesses from anywhere from sort of start-up all the way up to about 100 million, including sort of groups outside the UK, and shareholders, and basically any other sort of SME business essentially, and individual. So my remit can cover anything from companies, personal trusts, capital gains, VAT, basically a very wide scope essentially. That has supported me quite well, because some firms may have tax specialists who only sort of do one tax or another, and then sometimes on large projects you may need 2 or 3 people involved, which can sometimes get a bit, it may hinder the project in terms of slowing it down. So hopefully that's a massive benefit to Gravitate and their clients, that they've kind of got one person who can sort of cover so many bases and add value.
Perfect. So yeah, and today Luke's obviously just gone through a few things that he's seen as really hot topics in the industry. So we're just going to spend a bit of time talking through them. Like I say, hopefully we'll create some questions and conversation. But yeah, if anything pops into your head, just shout up. If not, we'll just keep chatting through it as we go through the slides. So yeah, first one, tax planning for your property portfolio. So again, what we're seeing a lot from our business clients is people are generating excess income, and they're looking at ways, or excess cash within their business, and they're looking at options, what they can do. So probably worth just talking through a couple of the sort of most common things you're seeing at the minute, Luke, from that perspective.
Yeah. So on the property front, it could be as simple as a landlord who's got the first property and they're looking to expand. They may have not even got the first property and they're looking to grow a big portfolio. They may already have a portfolio and they're looking at whether the vehicle that they're using is the most efficient one. So for example, it may be that all the property's in their sole name. They may be thinking about putting it in a limited company or a partnership or an LLP. There are many different options, and then it can come down to more specifics. So if you're a landlord or a property owner and you own residential property, you are exempt from VAT and you can't charge VAT. If you have commercial property or mixed-use property, you do have the potential to opt the property for tax and charge VAT, and there are obviously pros and cons in various cases. That is a very common area where you'd want to get an advisor involved, and in sort of very large cases the numbers can be absolutely vast that you could save. So we always sort of encourage clients to get involved with us as soon as possible as part of that process, and we can add quite a lot of value there. Other sort of property aspects that we see commonly is it may be you may be a business and you may be in, say, year 3, you may have had great growth and you're looking to acquire the property that you may be currently renting, or maybe moving to another property because you've outgrown your current one. And as you're looking to acquire it, the big question is how you acquire it and where you acquire it. Sometimes we see clients buy the property but buy it in the wrong vehicle, and then essentially when they're looking to move it later, they've got another round of sort of legal fees, accountancy fees, tax fees, etc. And better planning in the first instance could often have saved them a lot of time, a lot of money, and potentially a lot of risk as well. If the asset was just going to sit in an entity that essentially may have been at risk for a future liquidator or any other creditor potentially. So Property is always an area where if you're looking at acquiring property of any variety, I would always encourage reaching out to a tax advisor because it always pays dividends.
Yeah. So looking at a couple of those in a little bit more detail then. So the ownership model for the high net worth landlords, I assume the most common situations you're seeing at the minute are setting up a limited company to own them through, owning them personally. Is a trust, I suppose, no, not for personal, sorry.
Yeah.
So I suppose those are the most two common options then really, aren't they?
They are, yeah.
And I think one question we definitely get quite a bit like, how do you know whether personal or setting up that limited company is the best option? Is there a hard and fast way of giving an answer to that, or is it?
Yeah. There's not a hard and fast rule, unfortunately. I've had quite a few examples in the past where there has been generalisations done, and often when we've looked at the specifics of a scenario, it hasn't actually been better to follow the normal.
Yeah.
So I'm always quite cautious about saying what a standard general rule of thumb is. There are sort of, one thing I kind of would say is if you're looking to build a portfolio, you may look to set up a limited company, and obviously depending on what Rachel Reeves does in the budget, that may increase or decrease, especially if they increase more taxes on landlords that aren't companies. But what I would also sort of balance that with is the costs. So for example, if you're looking to acquire a few properties, it may be more tax efficient in a company, but your operating costs may also outweigh that tax saving. So it's not just a tax example, it's a bigger picture. What's your plan? And as part of a review, we'd look at what you're looking to do short term, what you're looking to do long term. Are you looking to give any of the value to family members? How much do you want to extract from the business, or do you want to just use that to reinvest in more capital acquisitions and growth? So there's so many different variables. It is a very specific example, a specific scenario may chuck out a different answer depending. And with that, we sometimes find that clients will look to discuss this after they've agreed a price on a property and they're going through the conveyancing. And sometimes that can get quite problematic, because if you raise that 4 weeks before completion, you may not have the time to get the advice you want and get the mortgage in another company name, or if that turns out to be the way you want to go. So if it is that you wanting to consider that and you have got a plan, whether you've got properties already, I'd consider doing it as soon as possible, because that planning may take 4 weeks, and at that point then you may want to look for properties in this new vehicle. And if you in fact, we've got one on at the moment where they're looking for property already, and it may be that if they had to acquire the property through, let's say, an auction, they may have to buy it in the personal name and then transfer it later, and again you're just incurring that second round of fees that you don't really want to if you could avoid it. So that's why sort of early planning is optimal, really.
No, of course. And then probably worth, like I say, about the options taxes, I think is fairly specific situation. So just looking at the property within your trading company.
Yeah.
Again, I know we probably go into it a bit further on, but I suppose this is one of the key benefits of a holding company.
It is, yeah. So as Sam says, if you've got a holding company whereby a parent company owns a trading company shares instead of a person owning trading company shares, the benefit of that is you can separate the ownership of the property. So if the property was to sit in the trading company and the trading company failed, or had a creditor try and sue them, or had a superfluous legal claim, for example, that property is essentially an asset of the company. In a worst case scenario, that may get taken in a liquidation to pay creditors. If that property was acquired within the holding company and the subsidiary was paying rent to the holding company, it's completely ring-fenced from creditors. So it's a common example where that is a very smart way to do it. Sometimes it may cause different issues on funding, etc. But often there are hurdles that we can get over that are reasonably routine and end up with a far better end goal. It may be, in some cases, it may be that the property may be acquired in a pension fund instead, and then let to the trading company. That's slightly more difficult in terms of the pension fund might not have the value to buy the property outright or be able to get a mortgage. The mortgage criteria is slightly more difficult for a pension. But again, we can advise on, it may involve paying a pension contribution into the fund to allow it to have enough cash to buy this property. and I've done that once or twice in the past. But I'd say those are the common points that we see on sort of holding companies.
Perfect. Any other key things that's sort of ongoing with property stuff at the minute you think worth touching on, or?
I would say the VAT one that we kind of touched on before. VAT in terms of property is probably one of the most commonly misunderstood and misadvised areas in certain circumstances anyway. Sometimes as part of buying a property, that can be completely overlooked when the solicitors are doing the CPSE forms, and it's a bit hit and miss depending on who you use. So if you are looking to buy a property, I would be raising it with the solicitors early doors about the VAT position and even the capital ounces position, because sometimes you could acquire a commercial property and in some instances there may be hundreds of thousands of pounds in value in that property that you want to claim. Again, it's not a quick process and you want to get sort of the planning done early on. In sort of extreme examples, I remember doing one last year and the capital ounces claim on a property where the client was insistent there'd be nothing was about 100 grand. We saved them a lot of money on the VAT because we got preferential VAT treatment, which saved them, I think, about 25 grand on stamp duty. And there was also a lot of bridging finance we saved them. So on a relatively quick piece of advice, we saved the client probably about 150k, all based on sort of property taxes. But again, it was because we got in early doors as soon as the property purchase was being discussed. If we'd have done that later on, it probably would have meant that we'd have struggled to get it done in time, or we may have delayed completion or lost the purchase.
That all makes sense. And a lot of the, again, I always come from a sort of an experience perspective in these questions, but I sort of see like the smaller, almost, I'm thinking like small clinics, small hairdressers, stuff like that. They generally, those buildings aren't opted to tax. Is that because they don't opt to tax it because they know whoever they're going to let the space out to, it's a small space, they're not going to be registered, so they're just going to see it as an additional cost? Is that generally like fall into the decision making of whether to opt to tax a building or not?
Yeah. So that can be valid. So if you're a landlord and you're letting the property to either a non-VAT registered business or a business who cannot register because they're supplying exempt services, then it would probably not be preferential to register for VAT, because if you did, you're charging that 10 and 20% more and there is no way of them claiming it back. Whereas if alternatively, if you had a property and you were letting out to an accountant or a manufacturing business who was VAT registered, they wouldn't mind if you charge VAT, because to them they can reclaim it. So it does. The decision will be influenced at least by the tenants, and obviously depending on the properties and depending on the permissions you've got of what sector you can let it to, depends on the decision making. Similarly, like with a hairdresser, if you've got a small hairdressers who aren't VAT registered, then as Sam says, it would be an additional cost. If that hairdresser was operating above the VAT registration threshold, and if Rachel Reeves potentially reduced that in the budget, more businesses may need to register, which could then change your decision. So in the past it may have been you didn't opt, and moving forward you may decide to. The important thing to say with opting to tax is it's a significant option, and if you did it, it has sort of long-lasting implications. So it's definitely not something I would do as a knee-jerk. It's where you want the advice to say, right, this is how it would look, this is how long it would stay in force for, and this is the implication on future sale. Because essentially, if you were to sell that property and you'd opted to tax, the default position is you then charge VAT on that sale price. In theory, the person buying that property may then be able to claim the VAT back. But again, if that person buying the property, if we use a financial advisor, for example, who are exempt from VAT, if they were looking to buy a property that had VAT on compared to one that didn't, to them it's an additional cost, which may then in essence push the property price down. So there are many angles to consider for VAT and opting to tax, but it's worthwhile broaching it because often it potentially can have significant benefits.
Yeah, and even for the businesses that are VAT registered, there's still that cash flow implication as well, isn't there? And we've seen a couple of deals that they haven't mentioned it until the last moment, and a client of ours were left in a position where they'd have to find that cash flow, even if it was for, I don't know where they were in the back quarter,
Yeah.
but they knew that they weren't going to benefit from that for 2 or 3 months, and they ended up chipping them on the price because they were like, well, look, didn't make us aware of this until now, and therefore you're making us find another X £1,000 for a short period of time.
Yeah.
They got the price on the back of it, so.
Yeah. It's definitely can be a negotiation point for that for sure, and it depends on how it's structured. So in certain cases you may have to pay the VAT on the purchase. On other examples, potentially you can have it where the VAT's essentially deferred and you don't have to pay it. That can be quite preferential, but again it comes down to the structure and how you buy it and where you buy it, and that's obviously what we can advise on, dependent upon what you're acquiring and the risk mitigation essentially. It's often quite beneficial on the VAT front if you do acquire it in a holding company, because that can benefit from some of these exemptions, whereas buying it in a trading company, if that's what your example was, Sam, you can't have that facility.
That makes sense. So let's jump on to the next slide. So if you do have any questions throughout, just feel free to, the best thing to do is put them in the chat. So there's a chat box at the top and you can just type away and we will try and go through them as we go along, or if not, if it's something a bit more detailed, we can jump off and do that separately. But yeah, until that, any questions pop up, we'll jump on to the next slide.
So the next one's what? Tax efficient employee retention and incentives. And obviously we see that quite a lot, don't we, Sam, in terms of small and growing companies wanting to retain staff.
Yeah, and I think even for us as a business, we have growth shares, so we have staff members who have access to growth shares. And again, for us, we as an accountancy firm, we want to attract and retain the best people. So for us to do that, we think growth shares is a really good option. So, I mean, you answered briefly. Just let's go through the growth shares first and go through line by line. Yeah.
So growth shares are a relatively new addition, and the basis for growth shares is essentially that instead of traditional shares where each share is worth an equal proportion of the company, growth shares build in some sort of hurdle value. So essentially, if you had a company that was worth 1.5 million and they had some shares that only had value above 1.5 million, on a sale at 1.5, the shareholders with growth shares wouldn't get any of the proceeds because they've not exceeded the hurdle. Alternatively, if that company sold for 3.5 million, then the growth shares would give them rights for the £2 million above the hurdle. The benefit of growth shares is essentially that if you're a business and you're growing but you want to get to the next level and you need a key member of staff, instead of giving away value in the business already, you basically sort of ring fence the value that you've built up for now and you share in any growth above that hurdle. The benefits in terms of that is that those growth shares can often be very low in cost because they have been there isn't as much value on day one because the hurdle is set at a level deliberately where the value is low. You can obviously set that hurdle lower. Obviously, the lower that you set it, the more value the employee may get on day one. But obviously, the aspect that we always consider internally and for the client's perspective is if an employee gets free shares or discounted shares, as we come to later on, and that would include on growth shares, is if they've got some sort of value, they would have a tax bill on it. So, for example, if somebody received growth shares worth 10 grand today, they would essentially be a benefit in kind, just like a company car or just like Bupa or any other sort of benefit. And if there's a tax charge on that, then obviously that employee's got to pay that without any actual cash income. Therefore, we'd call it a dry tax charge. And that's not normally something you want to do for a new person that you've brought in to grow a division or grow a business. So often, if that was the case, the employer may pay a bonus or may agree to pay the benefit in kind tax for them, essentially, which is an option. But obviously, each scenario and each set of numbers would be slightly different. The other beauty about growth shares is they can be done by any business. So they could be done by a trading business of any variety, as well as a property business. Whereas some of the tax incentive ones we come on to later have got quite specific rules. And the flexibility of growth shares is why they've become so popular.
Yeah.
Yeah.
So someone's just mentioned the signal did drop a little bit the last minute. So would you say there's any, I don't know, sort of going over a little bit, but is anything key that you were talking about then?
Yep. So I would say, so growth shares are highly flexible. Yeah, that is the main driver. The value of the growth shares are only above a hurdle. Therefore, as a employer and or business, the shares that you give away aren't going to have value on day one. They're only going to have value if that value grows. Therefore, if somebody's bought in and they don't grow the business, they won't take any of the value away from you, which is highly beneficial. I've mentioned about the flexibility, and because of the low value, the tax position on the employee is mitigated. If you just gave them free shares, the tax bill would be far higher because they're getting value for free on day one.
Perfect. Yeah, I think I could probably give some practical examples I've seen of this as well. So, what we, like I say, we have people who joined Gravitate. We've ended up having the company valued. So the first step is you get the company valued, because you know exactly what the business is worth at that date of transferring the shares. And so we sort of said, look, we've got this position, but we want you to support that growth for us. So we were able to give him those shares for nothing. And like I say, for easy numbers, let's say Gravitate was worth £1 million on that date. If it was, and he got 5% in growth shares, if after another year it was worth £2 million, he wouldn't get the 5% of the 2 million, he'd get the 5% of that 1 million being the amount it's grown by. But like I say, he was vested in the company and he's vested in the growth. Like I say, I think that's also another good example for bringing people in external, because it's obviously, if someone's coming in externally, that they haven't contributed to the success of the business at that stage, kind of thing. So you either have them buy in, where they're going to say, okay, you created something here, I want to buy a part of that, which is fine. Or you say, you haven't contributed to this, but you're going to contribute to the next step, and it's tax free. The problem, like Luke said, is that one in between, where someone wants a piece of the pie when they actually aren't willing to pay for it. Because like you say, if you go back to that £1 million example, and 5% of that, you're trying to give someone 50k's worth of value, and HMRC, you're going to say, okay, well, we want some kind of tax on that, because you're giving, there's a physical transaction happening there. So yeah, those are the examples, and where growth shares come in really as a good option. So we've got one question come in. So any implications, considerations of growth shares for employees or owners when investment comes on board?
Yes, I would say that obviously you've still got to be aware of, from investment, I suppose you're looking at external investment, whether you're looking at angel investment, etc. Growth shares would still work on that basis. I would have said the main thing for growth shares, or any sort of management incentive really, is these options are looking to sort of keep them in for the long term, but it's also, what's the long term goal? Are you looking to exit? Because they can be used as a position to say, right, we'll get some growth shares for 10%. That new manager or MD or whatever the title is going to help us grow, and it may be that person or group of persons then may acquire the remainder of the company and the original founders exit, or it could be that outside investments bought in to grow. One thing I would always consider with potential investment would be where the growth shares stand in terms of things like business asset disposal relief. If the company's wanting business asset disposal relief, it will essentially be a numbers game. So if you're only receiving 10% above a hurdle, you obviously want that. You need the proceeds to be high enough whereby they can satisfy the criteria for business asset disposal relief. If the values are quite low, then there's a risk that they might not get it, depending on the exact numbers. If investment's coming on board and it's really going to boost that, then that really should work hand in hand. Really push them on to the next level. I suppose every case is slightly different. It should work well for both. I suppose from the investment side, from the employer, it would be, how would that investment be structured? Are they buying off the founder Are they individually? Are they buying off the company as a whole? And exactly how does everybody's share structure work after the deal? It's definitely a strong consideration that needs to be had, but it's the specifics of what that investment would look like essentially.
Because you can dilute growth shares like other shares. So again, it all depends on that conversation that's been had and the agreement in place. But there is a flexibility to dilute them. But then, like you say, is that gonna sort of the whole goodwill of the growth shares and what you agreed?
Yeah.
If you then dilute them by 50% unknowingly,
Yeah.
it's whether you can get them bought into that. You can be like, look, we are going to take this investment and it's going to take this business to be 10 times bigger. If they've got a piece of, like I say, half the percentage of their share of business is 10 times bigger, they're in a better place. But if you're saying we're going to take this investment, it's going to double it, well then they're just diluting for the same end position. So I think, like I say,
I agree. It's a communication thing. If somebody's bought in and they're told it's worth 1 million now and it's going to be worth 5, and your percentage is this, if to get to that they're later get diluted, they're probably going to be unhappy. Whereas if, as Sam says, if you're aiming for 5 and actually this outside private equity comes in and you're going to get to 50, but they're going to have to go down from 7% to 6%, then I would have thought it's a no-brainer. Yeah. So it depends on what the position is when you sold it in the first place and what the changes are later on and how that would have effect to that shareholder.
Perfect. And then EMI. Do you want
EMI.
to talk through that one?
Yeah. So EMI is Enterprise Management Incentive Scheme. That's been in for around 20 years, I believe. It's a really good scheme whereby you apply for clearance with HMRC for the valuation. And I find from practice that you can get very preferential valuations from HMRC in terms of it can be quite low.
I'm not sure I understand.
Sorry, it can be quite low. Because you get it agreed up front with HMRC, they cannot then come back and challenge it later. That's the only probably downside to go back on growth shares, is you get a valuation, you can make it as robust as you want, but because you don't get it agreed and cannot get it agree with HMRC, there's the potential that they could come back and challenge it later. Theoretically, at least, that's why the valuation is so important in growth shares. But yeah, with EMI, there's certain criteria for the company and the trade mainly. Plus the structure comes into it and the employee, and if you satisfy all the criteria you can apply for EMI. And in essence what an EMI is in its simplest form is an option. So to use Sam's example, if Gravitate was allowed to do EMI and it's not, and it had a company worth £1 million and it had 1,000 shares, each share would be worth £1,000. Yeah. If somebody new came on board and essentially would be getting a 10% share in Gravitate, that would be worth theoretically 100k. Yeah. Through EMI and applying to the revenue, you would firstly agree the valuation of £1 million. Yeah. And then you're allowed to apply certain discounts to get that minority shareholding value down, and it may be that £100,000 value goes down to 25 grand, 20 grand, 15 grand, something like that.
So so the minority discount, how that works is because we're sort of talking about 10% of the business there, 10% doesn't give you any control. So although you're receiving 10% of the business, because you can't make the decisions and make the impact that you might want to do as a smaller shareholder, HMRC allow you to agree that it's not worth that full value. If you get, say, 50%, and you've got a lot of control at that point. So 50% of a company is generally worth 50% of a company, isn't it?
Isn't it, damn it?
Yeah. And then as you drop down to 10%, you can say, okay, although money-wise it's worth 100 grand, you're not in a position to the 90% of the shareholder, whether it's one person or a group of people, have so much control that your control is limited. So therefore, we can't say that the cost of that should be the same value, hence why you get this minority discount.
Exactly. So if we've got a minority discount on those shares and they're worth 20,000, an EMI scheme will normally be drawn up that says this new shareholder, let's say Sam, is allowed to buy those shares at £20,000, and there'll normally be a time scale or a performance criteria. So it may be that in 3 to 7 years that Sam can buy those shares for that agreed price, yeah, at an agreed time, subject to Sam hitting certain milestones. It may be that his division has to get 40% gross profit margin or a certain EBITDA. You can basically tailor it however you want. And hopefully over that 3-year window, if Sam sees the business grow from a £1 million business to a £7 million business, he still has locked in that low value from day one, which means that when he comes to acquire those shares may actually be worth 300,000 and he can buy them for 20, which is essentially an absolute no-brainer. Obviously, on the flip side, if it was the other way and the business had gone down from £1 million to £500,000 and Sam thought it wasn't going to improve, there'd be no point in him buying the shares for the 20 grand, yeah, and he'd just let the options lapse, so there's no cost to Sam. So EMI is a very good option for getting a preferential value and a discount for sort of minority shareholders. So if you want to, for example, incentivise your sales director and your finance director and your operations director or whatever titles you may have with a relatively minority share, they can get a good discount on those values and you can kind of lock them in long term. What we see in practice sometimes is that those options may be deemed to be what's called exit only, which would mean that they may be able to acquire, they can't actually acquire them after say 3 or 4 years, they can only acquire them on an exit. So what would mean there is, if I'd signed up some EMI shares in Sam's company, and in 7 years we were to sell out for 20 million, yeah, then as part of the sale process, I would acquire the shares for the preferential value we agreed with the revenue back 7 years ago, and immediately sell them for the huge value that we've got on the deal. So essentially it's just a bit of a paper exercise and it's highly valuable. Yeah, so on those exit onlys, we'd essentially have a preferential purchase price being a discount on the day one value, and then at the date of exit we sell the shares for a huge amount and we pay that nominal amount from 7 years ago. So essentially that shareholder can then appreciate loads of value and they haven't even needed to commit any capital in that 7-year period. So that can be quite preferential, and sometimes management teams may want that because they may not want those shareholders actually on the board as part of the growth, but they want them incentivised on the basis that they're looking for shareholder return essentially. Every circumstance is different. You may want them part of the, may want them to have shares sooner, some may want them to have it later. The other advantage of EMI to flag up is, dependent upon when you grant the shares, there can be a corporation tax deduction as well. And on a growing company, based on the numbers that we said earlier, that sort of corporation tax discount can be quite sizable. It just depends on the timing, the values and everything else.
And then just a quick overview on EMIs. And is there a common time where you'd use growth shares over EMI, or is it, again, I feel like we see a lot of growth shares at the minute.
Yeah.
Is that because it's more target? We work with more owner-managed businesses where we're targeting 1 or 2 people, where an EMI scheme, because of the upfront costs, is more beneficial to a larger...
Good point. So growth shares are definitely the flavour of the month, yeah, in terms of the flexibility. So that's why we hear them come up a lot, yeah. Sometimes it's because they haven't heard of EMIs that they don't mention EMIs, which often when we're having a chat we will bring up both of them. EMIs are really good in terms of the tax incentives and the risk, because they're low risk, well, zero risk, because you would get the evaluation agreed up front. Growth shares are slightly cheaper to set up, generally speaking, from a legals perspective that we find. And there's probably no hard and fast rule, but because growth shares don't have the rules that EMI do, that's why sort of everybody could do growth shares, whereas only say 30% of the economy might be able to do EMIs. Okay. So if you're ever looking at doing an incentive, even if you're really interested in growth shares, I would be open-minded to either or. And it may be that you do a combination of both. You may do some EMI and you may also do some growth shares at the same time based on the same valuation. We've got one at the moment that we spoke to last week, and they were discussing growth shares or EMI. Okay. They're actually looking at doing some free shares on day one, and then either doing growth or EMI for a long-term sort of vision.
Makes sense.
Yeah.
And then probably worth just spending a quick minute on the last one before we jump to the next slide and just work slightly away your time.
Yep. So the non-tax advantage options is exactly the same as EMI, but without the sort of tax advantage on day one, and they generally will only be considered if you can't do EMI. But that's why sort of growth shares have been bought in. So often non-tax advantage options are only really for big PLCs generally. because they don't qualify for EMI. The free or discounted shares, going back to what I was saying a couple of minutes ago, that is essentially if somebody joins the firm and they want 10% on day one, for example, and you as a director and a founder are happy to give them the 10% on day one, you may give them free shares in your company. If you did that, that is value that you're giving to him in lieu of cash, and that obviously is then a benefit to that director, that new shareholder, should I say. So there would be a benefit in kind, just like there would be a company car. So the shares of the business and those shares would need to be valued just as we would do for any other equity incentive. That I would say is reasonably uncommon, because if anything, you may value those shares and they may just buy them off you at market value on day one, so they've got skin in the game. You could have a hybrid where you give them at a discounted price. So if the shares are worth 50 grand, you may say buy them for 25. Then they've got a bit of skin in the game, and the other 25 grand discount is a benefit. It does happen, but it's more rare. But it is a potential, and it is in the toolkit to use to incentivise the team.
Yeah, I think it sounds like another one where it's just big on the agreement side, because like you say, if the time you see it is when someone physically wants to give someone the shares, and they think that's a really easy process, don't they? That what they need to consider is, they've got the shares, nice, 10%, it might be 10% of £1 million to 100 grand. So they've received 100 grand worth of value, but then they get a tax bill and they're really annoyed at you, even though you give them 100 grand worth of shares, because they're going to have to pay tax, certain taxes on that. So I think again it just comes down to the education piece.
It does, yeah. And with any of these, there are sort of reporting requirements to HMRC as well, because they would be essentially what's called employment-related securities. So with all of them, there's a valuation piece, there's some tax work on the implementation originally, and then there is probably some sort of annual reporting ongoing with all of them. And it's important that that's kind of followed up, and it may be, like we said earlier, that you may do one scheme, or you may do a hybrid of two, but dependent upon what your incentive, what your sort of plans are, we as a firm can offer it where we sort of do a valuation at the beginning, and then we kind of fan out the options from there. So it may be that you could have a small business that's worth 100 grand, for example, and they may want to give somebody 10%. And if that 10% is £10,000 with a minority discount down to 2, it may be that they just say, we'll give them free shares because it's not worth the legal costs of growth and EMI. Obviously, if that company is worth 1.6 million, that value was that much higher, and there may be that much more risk involved, that they may say, actually, it does warrant EMI or growth shares. But obviously, we can follow on the tax schemes after we've got the valuation agreed. And sometimes that's the hardest thing, because what a business is worth is subjective.
Yeah, of course. Cool, let's jump on to the next one. I'll let you know if any questions pop up.
So wealth preservation strategies for owners. So I suppose that's quite a good one at the moment, given we're on the run up to the budget. And probably the main one that comes up most often is inheritance tax. And I would say that we see that most often where a founder or family, for example, have built up a business over a number of years. They've potentially exited recently, or have got an exit on the horizon, whether that's an MBO or an EOT or a traditional trade sale. And they've moved from having loads of business assets, which are, or previously were, very efficient for inheritance tax purposes, to having generally a lot of cash, which are inefficient for inheritance tax. And sort of the number one sort of preservation strategies to start is with essentially a review of your estate, to look at what you've got now in terms of all your assets, where will you be in say 5 or 10 years, and what can we do to then mitigate those that liability. A lot of the times when I've looked at the figures on sort of day-to-day clients, let's say, often they've had a liability at the moment, but given the rates haven't moved for inheritance tax relief for probably about 17, 18 years, a lot of them haven't kind of realised the inflationary power on, say, property and companies would really impact them. And a lot of time the liabilities can potentially be into the millions, even though the value today may only be 100 grand, something like that. Obviously, if the inheritance tax liability is £1 million today on someone, I dread to think what it would be on 10, 15, 20 years unadvised. So after we've done the sort of valuation today, the forecast for 5, 10 years, whatever that may be, We can then look to put in strategies, whether that's gifting, lifetime reliefs, trusts, etc. We've got a various toolkit of what we want to do, and essentially you may, we would review them with you, we would go through all the options, and each person may like or dislike certain options, and it's not to say it's right or wrong, but it's a personal opinion. And essentially that would save a significant amount of inheritance tax. But what we also try and do is do like an annual sort of catch up, because it's great going through that exercise on day one. Let's say at age 60, you've sold your company, you've got 5 million quid, we can look at doing a plan, but then if you're not renewing that plan every 12 months, you can sometimes lapse into just wanting to stockpile cash because that's what you've done when you've built your business up. Yeah. So having that annual catch-up is really valuable in terms of mitigating the inheritance tax, because where you've got sort of multi-million pound estates, even if you only saved 30% of £1 million, you're talking £300,000, which is an absolute vast sum, and often it can be a lot more than that. What was the next one? Passing wealth down. So I suppose the passing wealth down, it could be, for example, where I mentioned before about the cash. Mm-hmm. It could also be as a bit of a hybrid scheme where you may have, instead of selling the business, you may have value in the business, but you may have family that's working and you may want to pass the shares to them. So it may be potential to either gift the shares to them or maybe do an MBO to family members and or a wider team. Which again can have benefits for inheritance tax, capital gains, etc. But that obviously depends on the appetite and the skills of the family members. Sometimes the family members may not want to take the business on, but there are sort of advantages that we can lever to really preserve more value. And then the third point on there is using surplus cash profits and investing them efficiently. So that may be trading companies that have got surplus cash or profits, or that may be individuals. And they may often look to do things such as trusts or family investment companies, where essentially they're investing it in a relatively tax efficient way. There are different tax implications to family investment companies and trusts, and it's probably going to take too long to cover on this webinar. But essentially, if the traditional approach of just investing in your own name is only going to make your inheritance tax position worse. Mm-hmm. So looking at the other tools that we've got, whilst checking whether you need any income from it or capital growth, can massively benefit you long term based on the compounding that we discussed earlier. And it's basically that sort of full approach should be done for any sort of wealthy client essentially that wants to look into their inheritance tax position, especially given I'm sure the budget will not make anything better from an inheritance tax front.
Perfect. The last point on that before we move on, or is that covered them all?
That's covered them all, yeah.
Perfect.
I've got one more slide.
Potentially two.
Yes.
Is there one more for this?
Let's just check. Yeah, holding company, I think we already mentioned, haven't we? So tax efficient shareholder exit planning is this slide. So essentially, if a shareholder is looking to exit a business, we always encourage them to speak to us in advance, in terms of basically just housekeeping, making sure everything's in order. It may be that you're happy that the business is going to be worth £2 million, and you may say, what do I need to do? It may be that it's not held in the right structure for you. It may be they don't qualify for business asset disposal relief. There are various things that may happen, or you may be confident it's worth 2 million, but you don't know how you're structuring your exit because you don't know who the buyer is. Yeah, so that may be a tax angle and or a corporate finance angle for Martin. So the earlier that we get involved, the better. And we can kind of put steps in place to facilitate that. And if you were looking to do an employee ownership trust, or in a management buyout, which are sort of common exit options that we see day to day, we can sort of facilitate that and help you with it in terms of obviously there is a management team that is there that is capable of running the business after the founders leave.
I suppose there's even an accounts angle there as well, because like you say, we do talk about this 2-3 years that you should be planning to sell a business, and people, I think everyone always thinks, this seems a lot, but like I say, what you've got to remember is the people buying this business are looking back over the last 3 years of numbers, and they're going to
scrutinise,
yeah. So like I said, we took a business through to sale, and it was going into the minutest of detail. I think what a lot of we were up against KPMG, and it was they will put all our numbers through I assume some kind of software that all just kick out anomalies, and they were just anomaly testing. So they were picking out fluctuations in margin from 2.5 years ago and one-off costs 2 years ago. So it certainly isn't I want to sell my business next month, let's get ready to sell.
Yeah.
Especially if you're not a business that's got strong management information, management accounts, budgets, forecasts, because again they were like, okay, how have you performed against your budget? Which is basically them saying, here's your budget for the last 3 years, here's what you achieved, are you good at budgeting? Because you're telling us in the next 2 or 3 years you're going to achieve X, Y and Z, but if you haven't hit your budget for the last 3 years, I'm not going to certainly believe it when you're trying to sell us this business. So I think there's a lot to it, but
there is, there's a lot, because I think when you go through that process you realise how heavy going it is. And a lot of the time when there's an exit, it's probably going to be one exit in a lifetime. There may be some shareholders that do it several times, but that's the exception rather than the rule. So Sam's right. If there's strong management information, that makes it a lot easier to go through those due diligence steps. And similarly from a tax perspective and a CF perspective, it may be that there are some skeletons in the closet that would be found by the buyer. And if we can run that dummy exercise 3 years in advance, sort out any answers for anything that can't be fixed so that they're ready to go to the purchaser, and or fix any other issues, then that makes it a much cleaner, tidier package when the purchaser is looking to buy. Plus, if we've got those answers ready and the MI ready, from a purchaser's perspective, it must be far better perceived as they go over straight away, rather than maybe taking a sustained period to come across.
Perfect. And then, like I said, let's just spend a few more minutes on the holding company. I know we've already chatted about it a bit, but obviously, again, something that's really popular at the minute is setting up the holding company.
100%.
Talk through some of those benefits.
So holding companies are used quite a lot for large businesses, but in reality, there can be a benefit to sort of a lot more SMEs than maybe do it. And one of the main sort of things that we see day to day as an advantage is asset protection. So if we've got a company that's growing really well, doing really nicely, and they have any issues, the assets within that business are essentially at risk. If instead you've got a holding company and you were paying the excess cash up as a dividend into the holding company, or if property was acquired in the holding company, or if the computers and the machinery was acquired in the holding company and leased down to the trading business, they're protected from creditors. That is the sort of number one it's a non-tax advantage really, because it's risk mitigation, but that can really ring fence the family jewels in the top company. The other benefit is, and we see this for numerous businesses really, is the sort of extraction of profits can become more flexible. If you've got, let's say, several shareholders who are debating the amount of dividend because one of them doesn't want to go over a certain threshold, for example, by using a holding company or holding companies potentially, you can have it where the dividends are initially paid up to holding company, and then the payment of dividends out of the holding company to the shareholders can be staggered essentially. So for example, £1 million dividend may go up from a subsidiary to a holding company, but only 200,000 may leave the holding company, leaving 800 in the holding company. If we'd have only paid 200 out from the subsidiary and we hadn't had a holdco, there's 800 grand of cash left in the subsidiary, again at risk. Separation is another good reason for having a holdco. So if you're looking at maybe acquiring new companies, and we see this quite often, sometimes a company may come up that you want to buy for synergy reasons or just because the price is great. If you've not got a holding company in place, you may buy it within your trading business. That could potentially cause problems in future if you look to sell that business. Because if you've got, let's say, a software company that's bought, I don't know, a cleaning company, for example, and somebody wants to buy the software company, they're not going to want the cleaning company in that envelope, are they? Which can then be quite expensive to undo later on. If that company was bought by a holding company, it's in a ready-made structure. And similarly, you may look to set up other companies in that group because you've got that ready-made structure set up as per the diagram on the right-hand side of your screen. You could set up more and more subsidiaries and have a wider group, and that may be that you could look to, if we used a restaurant for example, instead of having 5 restaurants in one subsidiary, you could have each restaurant in a subsidiary on its own, and then if one of them failed, it's separate completely from the other one, and no losses or credit risk, let's say, would be translated into the other subsidiaries. And it's probably also good from a management information point of view,
Yeah, of course.
because you've got separation.
Yeah.
Acquisition as well. So as I kind of touched on before, if you're looking to acquire, it's better to do it in this group structure because you've got them separate and not tied in with any other trades. And then the other point on structure is separation can often be quite good if you've got projects with a view to a sale, sorry. So it may be that you're looking at developing something with a view to sell it in 3 years, which could be a normal trading entity, development company, whatever. Having that set up separately makes it far easier and far cleaner to dispose of later on. And we see it common in construction, where you may have a developer who buys some land in Sheffield, develops 5 or 6 properties, sells the properties, but then sometimes keeps that company open. And if they do, that risk of those properties having any issues is retained in that company. Let's say if there's problems with a cladding like Grenfell or anything else comes up, that company remains liable. Instead, you quite often see that company will be liquidated or dissolved and a new company set up for venture number 2, where they buy some land in Newcastle or wherever. So again, it comes back to the structure is good for tax and non-tax reasons, often for risk.
No, perfect. Yeah, I think, like I say, holding companies, we're seeing a lot from a trading perspective as well at the minute. And like I say, just for those reasons listed there, and like I say, we're even seeing the examples, what we sort of loose touch on, where we've got 2 shareholders of one business, and the sort of one person wants dividends and they want different things out of the business. Some would rather leave it in and use it for future investments. So by having 2 holding companies sat above a subsidiary, like I say, it almost allows for these family-based businesses to sit above, and one of them can take all the money out and one of them can leave that money in there to build up to do future investments. So
yeah, whether it's a joint venture or anything else, it's their investment vehicle, isn't it?
Yeah.
And it does make it really flexible.